Good morning and welcome to the Czech National Bank's meeting with analysts. Today we are going to present the new macroeconomic forecast of the Czech National Bank prepared by analysts of the Monetary Department. Let me welcome our guests for today, the Bank Board member Karina Kubelková.
Good morning.
Acting Executive Director of the Monetary Department Jakub Matějů.
Good morning.
And forecasting team leader in the Monetary Department, Tatiana Keseliová.
Good morning.
Let's start with the macroeconomic forecast, and Jakub Matějů, the floor is yours.
Thanks a lot. I will now shortly, hopefully, present the contours of our new forecast, which was prepared as a run-up to yesterday's monetary policy meeting, on which the board decided to cut rates by a standard one cut of 25 basis points. We'll, as usual, start with the assumptions of the newly prepared forecast, then go over the main forecast itself, compare it with the previous one, address scenarios and risks, and then shortly introduce the upgrade of our core forecasting model, which we present in annex of our monetary policy report, which should be available by now, and we plan to switch to this upgraded model in next forecast in May as a baseline. Then, starting from foreign environment and its outlook, we are very cautious with the recovery of effective euro area. We expect the external demand from euro area trading partners to accelerate only very slowly, starting from second half of this year. I would like to point out that our assumption on German growth for this year, for 25, is 0.2 now, which is a lower boundary of forecasts from other institutions, such as the Bundesbank and German Finance Ministry, which have recently revised their forecast downwards towards our own numbers, so we are very cautious there. But looking at the broader picture, the 23 trading partners of Czech Republic, the picture is a little bit more optimistic, both on the current data, which show growth of this definition of external demand, around 1% year-on-year growth, but also in the outlook, which seems to go faster towards 2% growth in next year. Foreign price pressures after the deceleration or outright decline in foreign PPI in the effective euro area last year, there seemed to be a return to growth this year in 25, which would exert some price pressures from the external environment. Naming a few examples, the energy prices for businesses are higher, and also the pressures from food commodities are also visible. On the external rates assumption, we expect the ECB rates to moderate further towards the neutral territory. But what is important is the shadow rate. The ECB is now in a full tightening mode. It has discontinued reinvestments from both APP and PEPP programs, which leads to the shadow rate, the effect on market rates to be above substantially above the Euribor outlook itself. The Brent prices, despite the recent uptake, the forecast trajectory reflects the market pricing, which is firmly downward sloping. On the fiscal policy assumptions, we do not expect this quite strong nominal government consumption growth from previous year to repeat. The previous year was affected to some extent by the expenditures related to floods, which is not expected to happen again. But 25 is affected by raises in the public sector wages. Fiscal impulse after negative contribution in last year, minus 0.6, is expected to stay almost negative this year and also next year. Then moving on to the forecast itself, inflation has come down at the start of this year, but this outlook will be affected in the end by the flash estimate of inflation at 2.8, the print which we have seen yesterday, which brings a mild pro-inflationary risks to our outlook. And the amount of several decimal points, a few decimal points to be precise. Inflation will continue to moderate further, both in the definition of headline inflation and monetary policy relevant inflation. Monetary policy relevant inflation stays slightly below the headline because of the positive primary effects of indirect changes related to excise duty increases on tobacco and alcohol this and also next year. Composition of inflation, the drop or the easing of inflation at the start of this year is related to a large extent to administered prices, where the energy prices for household, both electricity and gas, are expected to have declined in January. Core inflation relatively stable, fuel prices in the first half of this year still contributing negatively to year-on-year growth, and food prices staying elevated, which is reinforced by the flash estimate. Cost pressures and profit markups. So what are the inflation pressures? How do we see it through the lens of our model? Going forward, but also interpreting the last year, the still elevated costs, be it from any direction, are compensated by reductions in profit margins as filtered by the model, but also the price pressures from the foreign economy, core import prices and energy import prices are expected to abate to some extent and will complement the domestic price pressures in a downward direction, where prevailing growth in wages in market sectors are expected to ease, complemented by gradual, very slow increase of labor efficiency, which would be an anti-inflationary factor, returning to its steady state negative contribution. Labor market is expected to ease somewhat at a very slow pace, which is consistent with very slow increases in unemployment rate. We have unemployment rate. We have seen these very gradual increases throughout last years. We expect it to continue towards our assessment of neutral rate or NAIRU around 3%. Nominal wages are expected to slow down, printing this year 6.2, next year 5.2. As with the gradual economic recovery, which creates basis for above equilibrium growth of wages, and also partially the compensation for high inflation period, which we observed in recent years. But these effects will dissipate over the forecast horizon. GDP growth, we have forecasted 2.0 for this year, 2.4 for the next. But again, we have received, since the completion of the forecast, we have received the flash estimate, which has been a few decimal points above our expectation, which creates mild risk in the direction of faster growth, again few decimal points maximum. Coming to the GDP components, GDP will be driven by household consumption this year and also next, but also we expect a revival of gross capital formation first, from the direction of change in inventories, which is expected to return to steady state real levels somewhere around 8 billion of CZK per quarter, but coming there from the recently observed numbers of still negative inventory formation, this creates pro-growth impulses. Starting from the half of next year going forward, we expect a revival also of year-on-year growth of private investment on the back of slowly reviving external demand and easier monetary conditions. What is interesting is the development of real exports. I would like to point you to this chart on lower right. In last 5 quarters observed data, the exports of Czech Republic were driven. The growth of exports of Czech Republic were driven primarily, exclusively by non-euro area countries. Euro area countries contributing negatively to export dynamics. There is a relatively big contribution of outside of EU countries to export growth, but there is also non-negligible contribution of EU countries outside the euro area, such as Poland and Great Britain. So we see this, we adjust our export forecast trajectories by this effect, not relying exclusively on EA6 or effective euro area aggregate. We have to take this into account, and we'll be addressing this systematically in the next quarters. Exchange rate, our forecast is roughly stable exchange rate. We expect for the first quarter 25.2, somewhat maybe somewhat weaker than the rates which are observed just now. Then broad stability, only mild, almost non-negligible weakening to 25.3. In this development, it is a composition of several effects. We still see a subdued growth of labor productivity in the economy. We expect a reduction of the previous very large trade surplus observed in 24. We do not expect it to repeat in 25. At the same time, there will be a renewed effect of exchange rate appreciation, but putting all those things together results in roughly stable exchange rate on the forecast horizon. With this forecast, consistent trajectory of interest rate is further decline towards neutral rates, followed by stability. Comparing our forecast with the previous one, I have to say that both flash estimates of inflation and GDP a little bit complicate this picture. But that said, we revise CPI inflation downwards. But against that, we have a risk coming from the flash, which would mitigate this downward revision to some extent. GDP, we revise downwards, mainly due to weaker growth in gross capital formation, which was observed in third quarter of last year. On the other hand, we got a substantial surprise in wages, especially in market sector, around 1 percentage point upwards surprise. So we propagate this, but we do not change materially the Q-on-Q profile for this year based on information that we have on for example, on wage tariffs, which seem to seem to be more consistent with what we have expected on Q-on-Qs also in the previous forecast. So the surprise is mainly third quarter last year and possibly fourth quarter last year. We revised the exchange rate trajectory slightly towards stronger exchange rate, mainly due to wider interest rate differential vis-à-vis the euro area. Decomposing the interest rate trajectory changes, which you might be interested in, how we revise our interest rate trajectory and what are the factors behind. The change is almost negligible. It's very small. We are speaking about decimal points maximum, but the factors which contribute to these revisions is at the start the initial conditions, where we observe the faster growth in wages, mainly market wages, which I've already mentioned. We also see a little bit more pro-inflationary composition of GDP growth, where private consumption surprised us slightly on the upside, fixed investment on the downside, which gives us some information about the productivity growth potential and let's say good part of this year. So the pro-inflationary balance of the GDP release which we have seen. This is counterweighted by a removal of part of expert judgments which we had in the last forecast because we were cautious about especially about private consumption growth and wage growth. We did not. We thought it might be somewhat faster. This we got in the data, so we removed part of the expert judgment. So this is the light blue bars on the downside. Going forward in the forecast, what is very important is the foreign environment and the revision of ECB rates compared to our November forecast, still going substantially down. So adding all those factors together gives us a slight revision of rates upwards at this year and slight revision in 26. Moving on to risks to the forecast, we have prepared this matrix of risks where one of our major risks is higher growth in service and food prices, which we address also using a scenario which you will see shortly. We see this risk as possible with the medium probability of materialization. Maybe after the flash, we think it's materializing more through the food prices than through the service prices, possibly high impact on domestic inflation and warranting tighter monetary policy response. We also see relatively fast growth of prices in a real estate market. We also see a revival of mortgage lending in both nominal and real terms, which we already observe in the data, but the impact on inflation is more, let's say, second round and needs further analysis. But as a whole, it requires somewhat tighter stance of monetary policy. On the other hand, we have we see a risk of deepening economic difficulties in the euro area with medium probability of risk materialization. Coming back to my introduction, where I have said that we are already very cautious in the baseline about the German growth this year and also the next. But if it would continue further, it would warrant looser monetary policy, both of the ECB and potentially also in terms of our Czech National Bank rates. We still see a persistently deep government deficit, which is a fact, so probability of materialization relatively high, but again, impact on domestic inflation is more of a second round through monetary aggregates and nominal imbalances in the economy. But might warrant slightly tighter monetary policy. Addressing some of these risks, we have prepared a scenario of higher prices in services and food, which materialized through more persistent profit margins, leading to CPI inflation being about 0.5 decimal or 0.5 percentage points higher in the peak deviation from the baseline, which comes towards the end of this year, warranting also higher rates this year, and despite the higher rates, stricter monetary policy, it implies also higher growth in nominal wages in market sectors. This is not the only scenario which we have prepared. On top of this one, we have added a scenario on of higher domestic inflation, so this is the previous one, plus economic downturn in the euro area. So you should see this one as addition of the previous one and the euro area more, let's say, more prolonged problems in German economy spilling over also to other euro area countries. This leads to prolonged stagnation in GDP effective euro area. GDP in effective euro area is not outright stagnation, but let's say that the current growth rate which we see we'll keep on seeing them all the way through almost like second half of 26, and only then the growth will substantially accelerate, which means more negative output gap in the effective euro area and also more supportive ECB monetary policy with rates going substantially below neutral for the ECB. What does this sum of those two scenarios imply for the domestic variables? We are tempted to call this scenario going in a stagflationary direction, but it's not a stagflation. It's the GDP still keeps on growing, so there's no stagnation. But we can call it going in a stagflationary direction. CPI similarly to the pure higher domestic inflation scenario comes higher around 0.5 percentage points towards end of this year in the peak effect. And the monetary policy reaction, this composite scenario requires is first addressing the higher price pressures from domestic economy, warranting higher rates, and then this turns below the baseline scenario when the monetary policy will address more the cyclical slowdown coming from weaker euro area demand. This all is consistent with somewhat weaker nominal exchange rate. We have also some risks identified by our scoreboard, mainly the cyclically adjusted general government balance to GDP, but also risks stemming from the area of growth of property prices and their gap. Speaking about the government sector balance, I would like to point out the latest number from the monetary aggregate statistics. The M1 has accelerated above 10%, M3 somewhere above 7%, with a contribution, sizable contribution of government when the previous breaking effect of central government deposits now turned positive when the government started to withdraw some of their deposits. So this is a thing to watch. Then the risk related to house prices. We observe already a double-digit growth in offered prices for flats, or asking prices for flats. Almost 11%. So this is also something to watch. This can have effect beyond the direct effect through imputed rent. This can spill over also to other parts of the consumer basket, affecting other costs related to housing, for example, reconstructions and renovations. So not only the new flats in the imputed rent. We also see revival on the mortgage market, which in nominal terms is obviously higher than the pre-COVID levels due to the price developments, but also in real terms, deflated by both CPI and the real estate prices themselves. We see return to levels which were common in pre-COVID times, 2018, 2019, which with hindsight we interpret as an overheating of housing market back then. So we should be cautious about these developments now also. Last but not least, we upgraded our core G3 Plus forecasting model, introducing US rates in the foreign bloc, which were not explicitly present previously. So this is why there is this straight line in the previous version of the model. We now explicitly work with 3 months SOFR rate as a proxy for foreign rates. Therefore, we also have an explicit US EA rates differential. We are able to interpret in a structural way the developments of Euro-USD exchange rate, also with better interpretation of Euro-CZK rate. We also changed a little bit how we work with the shadow rate. We acknowledge that the quantitative tightening of the ECB, which is now progressing at full speed, has somewhat smaller effect than the quantitative easing when it was announced on the market rates. So we introduced this asymmetric effect, pushing the Euribor rate somewhat below the baseline in the shadow forecast. Then, very importantly, we are introducing longer rates in our IS curve in the model. Now we work with 3-year government bond yield, which will be a part of monetary conditions in the model in the IS curve. We are also shortening the limited informational rational expectations scheme which we work with, meaning that the outlook of agents in the model, which was 9 quarters starting from the present period, now is shortened to 7 quarters. So there is a little bit of more degree of short-sightedness of the agents in the model, helping us to improve forecast accuracy in a number of variables in the model. For the details and more deeper discussion, see the Appendix 1 of our winter monetary policy report, which should be already available. How it materializes in the forecast itself, the GDP growth almost unchanged, CPI inflation almost unchanged, but we are able to provide implications and forecast of the long rates, the light blue line here, and we also change interpretation of the nominal exchange rate, pushing us somewhat to stronger exchange rate, but we are speaking about less than half of a percentage point, so almost the changes are very small. But the plan now is to switch over to this model starting from next forecast. Just this overview, a summary of the forecast and of the forecast changes. We have revised inflation slightly down, GDP also somewhat down, expecting headline inflation 2.4 this year, 2.0 for GDP, average nominal wage slightly up, 6.1 now, 5.0 next year. Revisions to the PRIBOR trajectory are almost negligible, and exchange rate somewhat stronger. Thanks for your attention, and we'll be happy to address any questions you might have.
Thank you very much. Yes, now it's the time for questions and answers. Just a quick reminder before you speak, please activate your microphone and briefly introduce yourself. So, Mr. Haverland.
Good morning, everyone. I've got two questions. The first one goes in the direction of foreign exchange outlook and the convergence process. So at the last model overhaul, we have seen that you softened a lot the real exchange rate appreciation. And in my understanding, the reasoning behind it was that the convergence process has slowed down or is almost non-existent. At the same time, it seems to me that it's picking up pace again. We have seen it definitely in the price domain. It returns now in the wages domain, and I believe as well in the real domain. So the real growth differential towards Eurozone and Germany is obvious. And the question is CNB then not kind of systematically underestimating the Koruna exchange rate? Is there not going to be a systemic bias towards weaker Koruna? Because we as well see a more potent rate differential vis-à-vis ECB. So this all goes more in the direction of stronger Koruna. And the second question is linked to the Eurozone downturn scenario. And my question goes more in direction, what if things go really wrong in the Eurozone? The ECB has to slash rates far below 2%, even come to negative territory with real interest rates for any reason. So do you have a plan or kind of reaction how the CNB would react? As we have heard, for CNB, negative interest rates, real interest rates are to be avoided. So what would be the scenario? And that links as well to the FX. We've seen in the scenario that the Koruna weakens a lot. And I assume that the ECB in such a situation would cut rates faster and more. So what is the story behind that? Thank you.
I think the first part is for my colleague, the second one maybe for me, please.
Yeah. Okay. Thanks for your questions. I have to confirm that we stick with the revision of long-term growth trajectories, revising downwards the steady state Koruna appreciation. This holds. My colleague then can maybe fill the details, but this is still with us, and this also implies that the outlook of Koruna exchange rate is almost stable. We do not see the standard appreciation direction which you used to see in our forecast and almost all or most of the past forecast which the CNB has published. So these counteracting forces going into direction of weaker CZK, such as the little bit worse current account and lower productivity growth, are enough to compensate for this weaker appreciation trajectory. If Tatiana would like to add something.
I will just add that we revised the steady states in the model in the last forecasting round, or the last one, and this is still true. And yeah, I think the Koruna is broadly stable in the forecast, so there is not a big appreciation in the following year expected by our forecast.
Okay. Now the second part of your question about the scenario. So we have two scenarios now in our forecast. They are the most probable or very probable according to the Bank Board. We discussed also the real stagflationary scenario. Maybe we will decide about it in our next forecast or for the next monetary policy decision, but it wasn't at the table right now, as it is not right now the most or very likely scenario.
Can I add something? we designed this scenario going into stagflationary direction as being very likely one. Also, let's say that the second modus of the distribution of likely outcomes. So something which we can very easily imagine happening, and we saw part of this happening in the flash estimate, somewhat stronger price realization. And we might see also something, also this prolonged stagnation in Germany very easily. So this is not a real stagflationary scenario. This is second best scenario in this direction. And yeah, so we can make it easily like more pronounced in both directions to illustrate a true risk scenario if things will go really wrong in these directions. But the results of the scenario which you already see give you flavor of the kind of reaction we would need to take.
Usually it is a bank board who decide about the scenario, so so we will decide wherever we want a stagflationary scenario the next time. So I always see it's not on me, it's on the bank board. In general, it is very hard to determine the next step of the ECB. You know it very well.
Thank you for the answers. And other questions? Mr. Schindel.
Thank you. My name is Jaromír Schindel from the Czech Banking Association. I have a question about the core CPI outlook. It still remains above 2%. But if I recall the speech of the Governor Michel, who mentioned that he would like to see the core CPI below 2%. So this is not following this, let's say, speech. But I don't think this is only about Governor Michel. I think that most of the board is not happy with this, or let's say, thinks that we need to have core CPI closer to the target if we want to fulfill this sustainability condition of returning to the inflation target. So I would like to ask why the model is still designed in the way that we have core CPI above 2%. And the question is also for the bank board, how would the bank board perceive this core CPI staying in the forecast above 2%? Thank you.
Okay, so the forecast as a whole and the forecast also of core inflation is a staff forecast. So when we see persistent pressures, and especially in the service sector, there might be grain of positive news in the flash, but not fully overwriting everything. So we still saw quite persistent growth in services, above 5%, net of imputed rents and all those things. The most persistent component of the whole consumption basket is growing at this pace. Creates risks. Our forecast, also based on the things we see of core inflation, is above the target for this year. We expect some, I don't know, those are technicalities, but some base effects from the holidays in summer. You are analysts, so you know how it evolved last year. So there will be positive base effect in June, most likely. And this will also, with the contribution of this, core inflation will stay elevated. I think the number is around 2.5 in most quarters of this year, according to the forecast, coming down closer to the target only in 26, with the contribution of still tight monetary policy, substantially above or somewhat above the neutral level.
Okay, thank you. Yesterday's discussion was related mainly to risks of our forecast, and the bank board perceived the overall balance of risks as mildly pro-inflationary. That's one of the reasons why we are so cautious and why we have this current monetary policy stance restrictive, and we are happy with that. and we want to keep our monetary policy restrictive or tight as long as we deliver our inflation to 2% target in a sustainable way.
Thank you. Mr. Bureš.
Good morning, Jan Bureš, CSOB. I have a question about neutral rate. Yesterday it was mentioned by the governor that the board in general sees still a rate bit higher than the internal staff. I would like you maybe to comment a bit on whether there are some debates still internally, both on the side of the internal staff and the bank board, and if this opinion in the board that it should be rather above 3% is a broad-based consensus. First question, and the second one, the forecast assumes on the horizon to get a bit lower below the neutral rate. Is that maybe the opinion also of the board that the bottom should be, or the floor should be maybe a bit lower than the neutral rate? I know this is a long time in the future, but still what the feeling is there.
Thank you. So our current rates are still mildly restrictive, even after the cut. We are approaching to the neutral interest rate, definitely. There was not a debate about the level of the neutral interest rate, but according to the latest estimates of our expert, the neutral interest rates is in band between 2.75 to 3.5. So still with inflation rate, with interest rates on 3.75, we are above the upper bound of this band. So it indicates us that we are restrictive. More in detail, my colleague can tell you more details about how they estimate neutral interest rate, but in our model, the R star is still 3%, and it's in line with the latest estimation. So it's in line with current assumption of our core model.
Yeah, thank you. Almost a reply to the whole question, but I will add a few points that we have just updated the computations which we have shown, and I think was May last year. The three models of neutral rate, the Hledík-Vlček model, the Holton-Laubach-Williams adjusted for the open economy, and the market pricing-based measure of neutral rate. Let's say that these estimates point to the range which Mrs. Kubelková has mentioned, 2.75 to 3.5. So given this range, even if the neutral rate would be on the upper boundary, the current rate would be still restrictive. And that's the main line.
Maybe I will just add, you also asked about the bottom, or the lowest or the lowest possible inflation, interest rates. So we agreed on not to giving any forward guidance. We want to go meeting by meeting and deciding about the level of our interest rates. So I will not tell you. More. Sorry.
Yeah, I can comment on the technical reasons behind that. Is because of the ECB rates being below the neutral level for the ECB, perceived neutral level for the ECB. So this is the result of this effect.
Thanks for answers. And another question, Mr. Haviland.
Thank you very much. My question is about the imputed rents that drive core inflation in the property market. So do you see the property prices growth peaking, and when, and maybe at kind of what growth? And second, if it becomes really potent as the kind of supply demand are really in imbalance, would the CNB react even kind of precautionary, despite not seeing the impact still directly in the core inflation and measured in the imputed rents? So you noted it's a low to medium risk, so you are not that much afraid that this could really become, in the middle of the year, an important driver of high core inflation. Thank you.
Okay, the housing market is a matter of concern. It can have several knock-on effects on the economy. We are not forecasting prices on the property market. We discussed the housing market as one of the risks for the inflation. It's related with the mortgage market, so money creation and credit growth. It can influence our inflation in a longer horizon. But some board members stress this risk more or put more weights on this risk. The other put less weight on this. So it's not unanimous, the position toward the mortgage market or house market development. We closely monitor the data. As you can see here on this slide, and this what we decided to do to monitor even closely, maybe to further analyze it, especially those knock-on effects, possible knock-on effects on the inflation.
Yeah. I would just point to the numbers which we already observe, which in the offered prices is already a double-digit growth, which is something to watch. And if it is any risk, then it goes in pro-inflationary direction.
Thank you, Mr. Schindel.
Can I just follow up to this question? Because it was also mentioned as the risk for the inflation. And have the bank board discussed the policy reaction if this risk materializes, whether the policy reaction is, let's say, means higher policy rate or not falling policy rate, or the bank board has started to consider the macroprudential measures? Thank you.
The housing market development is the reason of the cautiousness for the bank board. It's definitely one of the reasons to have our monetary policy stance restrictive. But the position on this risk is not, as I said, unanimous.
Thank you. And other questions? Mr. Renda.
Roman Renda, Czech Chamber of Commerce. In the forecast, you are mentioning that one of the main uncertainties is the situation in international trade. And my question is, how are you working with this factor in the forecast? If you have maybe some worst-case scenario, what it could mean for the Czech economy if the tariffs are especially high?
The impact of U.S. administration's trade policy or future trade policies is the major uncertainty for our current outlook. But as you know, the reliable information is scarce, At this stage, it is too premature to decide about the scenario. We prefer to wait for more information, and once the decision is made, we are ready to analyze it more in detail, to prepare more deeper analysis. But at this moment, we decided about two scenarios which are most likely, as my colleague explained. So we haven't prepared any catastrophic scenarios aside.
Maybe I can tell you a little bit how we think about it internally. We have the discussion is going in the bank. I mean, it's very lively in this respect, but we have also prepared some internal simulations already back in November. Now we work with for example, survey how other institutions see the potential impact on CEE, try to analyze what can be the impact on Czech economy. But the board decided not to demand or not to produce a specific scenario, also not to tie itself in a specific monetary policy reaction. If we would be showing a result of this scenario in terms of interest rate, and then the exact parameters of the trade policies would be somewhat different. We did not want to communicate anything explicitly, but we are closely monitoring it.
Thank you. Are there any other questions? I cannot. Yes, Mr. Schindel.
Thank you. I have two technical questions. The first one is about the 3 months Euribor, because again, there is the high assumption of 3 months Euribor compared to the market pricing, but the difference is smaller than it used to be in the previous round. So my question is whether this difference is going to prevail in forthcoming quarter, or it's going to disappear with these changes, with all these assumptions about the external interest rate environment. So this is the first question. And the second question is that you have introduced the 3-year Czech government bonds into the model. My question is, why 3 year? What is the advantage to pick up this tenor? Thank you.
Thanks for both questions. I can show you this graph, which shows the present deviation of our Euribor trajectory from the monetary policy report winter, this one, against the most recent Euribor futures. So the line is almost identical. We stick with the expert view, but if the difference is now almost negligible, and going forward, we'll be happy to switch back to the market outlook if the conditions would allow. On the second question, okay, the 3-year bond. Why 3 years? This is a very good question, and we have discussed it thoroughly. I would say that the main reason is that this 3 years is still relatively comparable to the horizon of the forecast, and we can have tangible impact of the compounded short rates on the 3-year rate, and this is one of the main reasons, so that it maintains a bit a character of monetary policy instrument being affected by the short rates and their trajectory. If we would be to move on to 5 to 10 years, the sensitivity to any monetary policy changes and communication which we want much smaller. So we like to keep it closer to the forecasting horizon. At the same time, 3 years, very liquid maturity, and so we decided to stick with that.
We will present the public with deeper description of the changes we've made in our shadow forecast, so which will be effective or will work as our main model starting spring this year. So please be patient.
Yeah. The first thing, as the annex to the monetary policy report, we also plan a blog post about the changes coming in the meantime, and we also plan to update the description of our forecasting tools, which was published in fall last year, related to the monetary policy review communication. So we plan to implement into this document the description of the model changes.
Thank you. Any other questions? We have time for maybe one last question. Mr. Schindel.
Thank you. There have been several changes in the staff regarding the creation of model. You have established a new department to create a model, so I would like to hear from you what you think about the timeline, how this is going to be, how it's going to develop in future, what will be the main model in the future, how will be the impact on the communication, where you are at a very early stage, or have you already progressed? Thank you.
Okay, as you might have noticed, we have a new department, research and statistics department formed in the ECB. It is in line with the recommendation from the monetary policy review. One of their goal is making use of new data and implement new technique in modeling and analysis, and also to develop the new alternative model to complement the current G3 model. But it's a project for a lot of months, maybe years. So it will take time, and so we haven't. So we need to wait for the results as a bank board, and then we can make some decisions. So.
I can add that you, as a primary recipient of the forecast of the Czech National Bank, will be updated about any changes which can come up during this process.
Definitely, we will keep you informed. Don't worry.
Thank you everyone for participation. Thank you for your questions. Thanks to our colleagues to their answers, and we are looking forward to seeing you again in May.
Thank you. Have a nice day.